Welcome to Nasdaq Trade Talks. I'm Joe Malandrino, global markets reporter at Nasdaq. Joining me remotely is Phil Mackintosh, who's the chief economist at Nasdaq, to review how policymakers and investors are starting to model out the global economic impact of the coronavirus as the race is on to mitigate the spread of the virus and provide stability to the markets, consumers, and the economy. And before we take a look at what the potential impact could be to earnings going forward, let's discuss March jobs data, Phil. First decline since 2020, and it's a pretty big drop for U.S. payroll.
Yeah, and I think it could realistically be worse. So the fact that we sort of finished March a few days ago probably helps this data. We know that there's about 10 million new unemployment claims, and that adds to pretty close to 10% unemployment rate. So, I think the reality is the unemployment rate rose from 3.5 to 4.4, but the economists are mostly expecting it to get closer to 10%. Pretty quickly, actually.
All right, let's move along to our second set of slides here. United States, a COVID-19 update. Curve's not looking too good here.
No, we're winning at something. Unfortunately, it's not what we wanted to win at. The good news, I guess, is you can see that Italy has definitely started to flatten their curve. South Korea does seem to have completely flattened almost their curve. And countries like Japan, which have had a pretty good testing regime in place, have kept their curve or their rate of growth relatively slower. So things can be done. The good news, if Italy's flattened its curve, is that it can be done in a Western country as well. Even Spain, you can see in that chart, has started to get its curve to flatten. So hopefully we can get our curve to flatten in a week or two as well, and things might look a lot better if that starts to happen.
Moving along to our next slide here, the impact of acting fast. That could be one positive spin to this if we can get this under control.
Yeah, and I think that's a key point is when you look at the power of exponential growth, I mean, we should all know this, we're in the financial markets, the power of compounding if you start saving younger really does help you to get savings by the end of your life. Similarly, when you can get your lockdowns in place when there's only 1,000 odd people with the coronavirus, the chances of it spreading to 100,000 is much less than if you wait a little bit longer and suddenly you have 10,000 cases like Italy saw, and it became much harder for them to actually isolate the people and stop the spread of the disease. So this chart's kind of interesting just because it really does show the power of the compound growth and the importance of getting this under control early.
All right, let's wrap it up with future earnings. We know the second quarter is not going to be good. What does that look like for the third and fourth quarter? It's almost like when we were talking about data throughout the week. We know it's going to be bad. We just don't know what the duration looks like.
Yeah, and that's really the important point, isn't it? I mean, the data that's coming through for workers is obviously very negative. There's reports that hourly workers are 50 to 60% down on just a couple of weeks ago. So there's a lot of people furloughed. There's a lot of industries earning almost nothing compared to what they used to earn. There's some bright spots. I mean, obviously grocers are doing pretty well. The internet delivery companies are doing quite well. So there's some bright spots, but the question for all the companies that have been told to sort of stand down and work from home or stay in place really are hoping that the curve flattens. It flattens in the space of, say, 3 or 4 weeks, which is what we've seen. I guess you could say with Italy and definitely with China and Korea, have managed to get that curve under control in the space of a month, and could pretty comfortably a month later say that it's more or less safe to go back out and start to socialize and do real work again. If that happens, there could be some pent-up spending. There could be a lot of people that have delayed spending, and Q3 could see an extra surge in demand. The real question is that when we start to get back and start spending? And so the forecasts for Q3 and Q4 are a bit mixed at this stage, just depending on how long people think this is going to take for the Western economies to get through. But there's I guess a hope and a lot of forecasts that say the bounce back should be pretty dramatic. So even though the numbers that we're seeing in terms of unemployment and GDP cuts right now compare unfavorably to the credit crisis just 10 years ago, the credit crisis lasted 2 whole years. So if this lasts 1 quarter or even 2 quarters, it won't end up feeling quite as bad as the credit crisis did, which we all lived through only 10 years ago.
All right, Phil, appreciate the insight as always. Thanks for everything this week. We'll talk to you the following week.
Looking forward to it.
All right, thanks for joining me on Trade Talks. I'm Joe Malandrino, global markets reporter at Nasdaq.